A stack of coins sits on a table. Each month, one coin is removed. The stack barely shrinks, but the interest quietly grows on the other side. Every month, a credit card bill arrives. It shows two numbers. One number is the full balance. The other number is much, much smaller. Most people choose the small number. It feels manageable, affordable, and safe. That feeling is exactly what the bank is counting on you to have. When you pay the minimum, you cover most of the interest. Almost none of it touches the original balance. The debt stays near the same size. Think of it like a bucket with a small hole at the bottom. You keep pouring water in. The bucket never empties because the hole is too slow. That water going in is the interest being added each month. That tiny trickle out is your minimum payment doing its job. The bucket is designed to stay full. Banks did not always offer minimum payments. This feature appeared gradually, over decades. Each step made borrowing feel easier without making debt go away faster. In the early days of consumer credit, lenders expected full repayment within months. Debt was treated as a short obligation with a clear and definite end date. Then lenders discovered something important. A borrower who pays slowly generates far more total revenue than one who pays everything off quickly and completely. So the minimum payment was not invented to help you. It was designed to create the longest possible paying period. More time means more interest collected overall. Here is how the interest calculation actually works each month. The bank takes the remaining balance and multiplies it by a small daily rate. That amount is added back in. If your balance is 1,000 units and your monthly rate is 1.5%, the bank adds 15 units before you even make a single payment. Now you pay 25 units. 15 go directly to the interest. Only 10 units actually reduce your balance. The debt shrinks by almost nothing this month. Next month, the same thing happens again. The balance is still very large. A new layer of interest is added. The cycle repeats with no natural end in sight. Over 2 years of minimum payments, the original debt may shrink by only a small fraction, but the total amount paid has already exceeded what was originally borrowed. This is the core of the minimum payment trap. You are paying real money every month, but the debt is structured so that most of your payment feeds the system, not the balance. Now consider how the bank sees this same transaction. Every month you stay in debt is another month they collect interest. Your slow payment is their steady, reliable income stream. In fact, the most profitable credit card holder is not someone who never pays. It is someone who always pays just enough to stay in the system indefinitely without defaulting. This is counterintuitive, but true. A borrower who defaults costs the bank money. A borrower who keeps paying minimums earns the bank far more than the original loan was worth. The minimum payment amount itself is not random. It is carefully calculated to be just large enough to avoid default and just small enough to keep the interest growing on the balance. Some credit agreements set the minimum at just 1 or 2% of the outstanding balance. On a large debt, that amount covers almost nothing except the monthly interest charge added back in. If you want to understand how much a debt truly costs, you need to think in total time, not monthly amounts. Time is the variable that the minimum payment stretches as far as possible. A typical debt paid by minimum only can take 15 to 25 years to fully clear. During that time, the borrower may pay 2 or 3 times the original borrowed amount in total. If you find this kind of explanation useful, subscribing keeps you informed as we walk through more mechanisms like this one. Each video explains one more piece of the economic system around you. Now here is something that surprises most people. Paying even a little more than the minimum each month compresses the repayment timeline dramatically. The math shifts direction quickly. The reason is simple. Extra payment reduces the principal faster. A smaller principal generates less interest next month. Less interest means more of your next payment reaches the balance directly. This creates a positive feedback loop in the borrower's favor. The more you overpay, the faster interest shrinks, and the faster each additional payment does useful work on the real balance. The minimum payment system does the opposite. It keeps the gears turning very slowly. The interest layer stays large enough to absorb most of your payment before it reaches the balance at all. Credit card companies understand this mechanism extremely well. Their systems are built to encourage minimum payments by making the small amount feel generous, reasonable, and sufficient for the month. There is also a psychological effect at work. When you see a small number, your brain interprets it as a small problem. The debt feels manageable even when the total balance is large and growing. Behavioral economists call this the monthly payment illusion. People evaluate affordability based on the regular installment, not the total cost. The system is structured to highlight one and hide the other. The same psychology applies to many financial products. Mortgages, car loans, and installment plans all present a monthly number first. The total is always somewhere further back in the process. Credit card balances also compound. When unpaid interest is added to the principal, the following month's interest is calculated on the new, larger total. The balance feeds on itself over time. This is called compound interest, and it works in reverse when you are the borrower. The same mechanism that builds savings wealth over time is the one that builds debt weight for those who carry balances. Most people understand compound interest when it grows their money. Fewer think about it actively when it is growing the amount they owe. The direction changes, but the mechanism is completely identical. There is one more layer to explore. Many credit agreements also include penalty interest rates. If you miss a payment or exceed the limit, the rate can increase sharply, adding even more to the monthly charge. Penalty rates can be nearly double the standard rate. A borrower who was already paying mostly interest suddenly has even more interest added on top of an already slow shrinking balance. At this stage, the minimum payment may not even cover the new interest charge at all. The balance can grow even when you are paying. This condition is called negative amortization, and it is a real state. Understanding these mechanics does not require any financial background. It only requires knowing that time multiplies whatever rate is applied to a balance that is not actively shrinking month by month. So what does a better strategy look like in practice? Paying any fixed amount above the minimum creates a stable reduction curve. 1. The balance drops faster each month because less interest is owed overall. Even paying 10 or 20 additional units per month makes a significant cumulative difference over a year. The compounding effect reverses direction when the principal shrinks faster than interest accumulates each period. The system was designed with specific assumptions about average borrower behavior. Those assumptions include the expectation that most people will continue paying the minimum for as long as possible without questioning the structure. Awareness of how the system works is the first step toward using it differently. The mechanism does not change, but the person operating within it can change how much of each payment goes toward the actual balance. The minimum payment is not a suggestion for how much to pay. It is a floor set to protect the lender's income stream. Paying above it does not break any agreement. It simply redirects where your money goes. The debt system continues operating the same way for everyone inside it. Each month, the minimum is calculated, the interest is charged, and the cycle resets. The structure holds as long as the payments keep arriving on schedule.